Tesla stock to gain 50% soon. Hello everyone and welcome back to my new video. Tesla stock traded above $1,200 a share early Tuesday, putting it close to its all-time high of $1,243.49. As the stock rises, it soared by double digits on Monday. Expect more debate about how to value shares of the EV leader. Tesla delivered 308,600 electric vehicles in the fourth quarter of 2021. For the full year, the company delivered 936,172 vehicles, marking an 87% rise year-over-year. Wall Street analysts had expected Tesla deliveries of 267,000 in the fourth quarter and 897,000 for all of 2021. According to a consensus compiled by FactSet, investors rallied around the stock, as deliveries are the closest approximation of sales reported by the company. Tesla will announce earnings for last quarter in the coming weeks. Tesla CEO Elon Musk has said he wants to increase the company's vehicle sales volume to 20 million annually over the next 9 years. As part of that effort, Tesla is set to start production of the Model Y crossover at its new factory in Austin, Texas. This year, it aims to open another factory in Brandenburg, Germany. After that, Wall Street, for its part, appears to believe the stock is worth roughly 100 times Tesla's per-share earnings. That is about 10 times more valuable than stocks of traditional automakers. But it seems about right, based on one valuation methodology. Electric car maker Tesla, Inc.'s stock, which surpassed $1 trillion valuation this past year, has witnessed a reversal of sorts in 2022 amid a broader market sell-off in tech stocks. Even a stellar earnings report and record profits failed to revive its fortunes, the stock having fallen by more than 11% after the call. However, analysts who issued bullish reports ahead of the company's earnings are predicting a turnaround for Tesla. As of this writing, the stock is trading at $913.99, up roughly 8% from its price at the day's start. An attractive growth story. Dan Levy, analyst at Credit Suisse, upgraded Tesla stock to outperform from neutral in a note this morning, stating that the pullback creates an attractive entry point. From its peak of $1,199.55 on Jan. 3, 2022, the stock is down by roughly 24%. As of this writing, Levy acknowledged the recent downturn in growth stocks since the start of the year and said that Tesla had been disproportionately hurt by it. But he made the case that the stock will recover from its current slump. Tesla is a one of one. We are hard-pressed to find a stock that checks all the boxes as Tesla does. Attractive growth story, disruption, decarbonization, etc. He wrote, adding that robust fundamentals will help resuscitate Tesla shares. Tesla recently reported earnings that surpassed analyst expectations. It had earnings per share of $2.54 and record profits. The company delivered 936,000 electric vehicles, a new high, last year. Based on its latest earnings report, Tesla also has the best operating margin among electric vehicle manufacturers. Strong margins are critical not only for, but also as we expect Tesla to eventually use its margin strength plus software standardization to spur volume growth. Levy wrote in his Note 1. During the pandemic, Tesla also expanded its operations to include more manufacturing facilities in Austin and Berlin. The additions should help boost the company's output above its current goal of increasing output by 50% each year. During the company's earnings call on Jan. 26, Zachary Kirkhorn, chief financial officer at Tesla, said the target was actually achievable with just our Fremont and Shanghai factories. 2. With less question around demand and much more question around supply of EVs, Tesla should be a key beneficiary. It has a product lead versus other and has taken the most holistic approach in EV supply. Not only does Tesla not have to tackle the challenges that legacy must address, but Tesla also has leads in supply, vertical integration, software, product simplicity, and capital availability. Levy from Credit Suisse wrote, he has a price target of $1,025 for Tesla stock. Levy's price target trails even more bullish estimates for the electric car maker's price from other analysts. For example, Wedbush Securities analyst Dan Ives, a longtime Tesla bull, has predicted a price of $1,400 for the company. We're only in the second inning of what's going to be a $5 trillion green tidal wave. The stock's selling off here, we just view it as an opportunity to own this more, he told Yahoo Finance after the earnings call. Can Tesla really quadruple its share price to $3,000 by 2025 to become the most valuable, biggest earning enterprise on the planet, headed by the richest person? And not just achieve all those superlatives, but zoom at a speed that leaves Amazon, Apple, and Microsoft far behind, and puts Elon Musk so many laps ahead of the Gateses, Bezoses, and Buffetts that they'll have to race to catch him and probably won't. In effect, that's the new prediction from ARK Invest, the firm headed by longtime Tesla enthusiast Cathie Wood and whose funds hold over $3.2 billion in the F-Maker's shares. In a March 19th post on the ARK homepage, analyst Tasha Keeney wrote that ARK is raising its already head-spinning estimate that Tesla would hit $1,400 a share in 2024 to a new target of $3,000 by 2025. Investors took the projection to heart, lifting its shares 6.2% or to $698 or by $41 billion at midday on Monday. ARK expects Tesla to soar more than fourfold from there over the next 4 years and 9 months. If that happens, its market cap would reach $3 trillion, assuming its count of shares outstanding remains around today's levels. Keeney's report is well written and presents a detailed roadmap showing how Tesla can get there. The predictions are based on a Monte Carlo model. ARK used 34 inputs to generate 40,000 possible outcomes. Result: the probabilities generated by those simulations gave Tesla a 1/4 chance of hitting $1,500 by 2025 in the bear case, 1/4 odds of reaching $4,000 in the bull scenario, and pegs its most likely price 5 years hence at $3,000. It's interesting that the least optimistic of the three forecasts has Tesla more than doubling, or rising at an annual rate of 18%. Through the close of 2025. The ARK take merits a close reading, in part because it exerts such a strong influence on investors. Stepping back from the numbers, Black listed what he called 4 ingredients for electric vehicles: battery range, performance, technology, and safety. While the competition is catching up on battery range, he said that for performance and technology, Tesla is still ahead of the competition. He added that Tesla has, by far, the highest number of fast charging stations available, and that drivers of competing EVs can buy low-cost adapters to use Tesla's stations and possibly feel envious of Tesla owners while waiting. For safety, he said Tesla's track record is good, and cited General Motors Co. SGM -0.12% recall of Chevrolet Bolts for battery fire risk, and GM's instructions to customers on how to limit that risk. Finally, Black addressed concerns that increasing competition in the EV space would hurt Tesla's market share or make it less profitable. Black cited Amazon as an example, citing skeptical investors years ago who had expected traditional competitors to take back market share from Amazon as they build out their online sales capabilities. We all know this didn't happen. One thing we can all be sure of is that the world will continue to change rapidly for all vehicle manufacturers as buying habits change and governments continue to push for a rapid transition to EVs. The fundamentals: it's a big leap of faith, says Jack Ciesielski, one of the nation's top accounting experts. Ciesielski notes that ARK isn't making its case based on the fundamentals usually deployed to value stocks. They're not thinking about Tesla in traditional ways. When Warren Buffett talked about Coca-Cola way back, he'd cite that they sold a little more soda and raised prices every year, both at a predictable rate. The foundation of predicting the stock price was the discounted present value of those predictable cash flows. Those cash flow forecasts had a high degree of certainty and were an excellent guide to where Coke's shares were heading. If Coke's price dropped way below the present value of its reliable stream of cash flows to come, investors would pounce and send its price back to fair value. Ciesielski isn't faulting ARK for its methods. When you have a company where the future is this uncertain, you have to do it the way ARK did, he says. You have to guess on the most likely inputs and put up boundaries around those guesses. But crunching a bunch of educated guesses in a mathematical model doesn't necessarily generate an outcome that's a lot better than a result based on traditional analysis, such how fast the auto industry will grow in the future, and how much of that growth Tesla is likely to capture. One thing I don't see in this analysis, says Ciesielski, is the competitive picture. This is all for today, folks. If you enjoyed this video, then leave a like, and if you are new, then don't forget to subscribe. Stay tuned for the future updates. See you till the next video. Thank you for watching.